Well, hi folks. I hope you had a fantastic weekend, and we're going to have a look at the charts very quickly. We had an interesting week last week with markets moving up and down, kind of sideways on stock market indices, and some strange movements on currencies. We had the big jobs number on Friday, the non-farm payrolls, and with unemployment reaching a 69-year low and just really a bumper number once again for non-farm payrolls, the markets didn't react as one would expect. And I've been trading this market for about 20 years now, a little bit longer, and I've never seen the dollar react in the fashion that it did on Friday. There's some interesting ideas that can be gleaned from that. So let's have a look at the charts and see what went on Friday. Let's have a look at the jobs numbers, but more importantly, let's have a look at how the currencies, the stock markets, gold, etc., and also natural gas and oil and a couple of other commodities, and see how they reacted to all sorts of shenanigans going on in the markets last week, and also all the news of bank collapses going on, which is really concerning for both the bears and the bulls for different reasons. Let's have a look at it on the charts. So here's the non-farm payrolls, and a couple of interesting things. First of all, we'll have a look at the numbers, but there's a little note at the top of this which you might find interesting, and particularly right at the end here. The March reading was revised sharply lower to 165K from an initial estimate of 236, and they've been doing this quite a lot. So they come out with a bumper number, and then they revise it down when they announce the next bumper number for the following month. I'm not too sure if we can rely upon these numbers as being accurate, because they keep on giving these really big numbers and then revising the last month's numbers down at the same time as they announce the current month's really good numbers. And I think we might have the same problem with various numbers that they're announcing to try to balance this problem that the Fed has between inflation and economic growth and interest rates and potential stagflation approaching, trying to keep some sort of optimism in the economy, but at the same time trying to decrease the expectation of a pivot or rate hike reduction or slowdown in rate hikes. So we're seeing them doing a very delicate juggling act, and I think manipulation of the numbers might be part of that dance that they're dancing. Keeping all of that in mind, these are the numbers that have been coming out over the last number of months. Going back to mid-2022, you can see we've got numbers of 300,000, over 300,000 many times, up in the high 200s. Then we had that big number, 472. And then this month, 253,000 jobs. Bear in mind that any number over about 120 or 150,000 is considered healthy and good. And these numbers are extraordinarily high and consistently so. Having looked at those numbers, let's have a look at the unemployment rate. And if we go to the unemployment rate chart, you can see the number that's just come out is 3.4. But if we look at the longer term trend, and it's going to be a bit disrupted by the COVID period, of course, you can see this number right where we are right now is actually the lowest it's been in something like 69 years. I think the last time we had this number as low was in the 1960s. I think we've just reached a new low, equivalent to somewhere around the 1960s. So an incredibly low unemployment rate, consistently high non-farm payrolls, and various other jobs numbers that are coming out from different sources are really good. What the Fed keeps on saying is as long as we see a strong jobs market, high wage growth, it's going to put pressure on the inflation rate, and it's going to put pressure on their need to continuously increase or at least maintain high interest rates. With all of that being said, and considering that high interest rates are not good for the market, they're meant to be good for the dollar. They're not meant to be good for the stock market or gold. They're meant to be good for bond yields. We look at the charts and we see a completely different picture to what we think should be going on. And that's why we're going to have a look at the charts right now. So here we are back at the charts again. And really what a messy set of charts that we have. I want you to do one thing before we carry on with this video. Perhaps you can do that now. I'm putting a link in the top right-hand part of your screen right now. And you can have a look at yesterday's video, where I made a broader observation about the market. I want you to watch that and then kind of put this into context with what I said earlier in the video about jobs. And then when we have a look at these charts, you can kind of fit that into what we've just talked about on jobs and also what I said in yesterday's video. So the link's at the top right hand of the screen right now for that video. I'm going to go through the major currencies, the euro and the pound against the US dollar. And I'm also going to look at the euro and the pound against the Canadian dollar and also the US dollar Canadian cross rate. So what we see on the euro is that actually we've just moved sideways underneath this 1.11 level for quite a long time now, a couple of weeks, at least 2 weeks. But we have broken down through this channel bottom and On two occasions in the last couple of days, we pierced the 20-period moving average and just touched that red line support level, which goes back quite a long way. So we've showed some weakness in that we didn't reach the channel top. We've been going sideways. We've formed various wick and spike highs up around just below the 1.1 level, and we've tried to move down. With the non-farm payrolls number on Friday, the euro did begin to move down as the dollar moved up, but it sharply moved back up again, forming a wick low and this sort of spinning top candle on Friday. I don't know which way the euro is going to go. All of the information that I've given you earlier in this video and in yesterday's video, and the complete confusion that exists in the market regarding the dollar, interest rates, inflation, bank collapses, stock markets, bonds, everything's just really up in the air right now. For the moment, we're short on the euro, and as long as we hold roughly beneath 1.11, and ideally this channel bottom, I'm hoping for the euro to move down into some of these lower levels and all the way down, perhaps down to 1.05. We'll have to see how that goes, but the fact that we didn't move down with such a strong jobs number, the lowest unemployment in 69 years, everything pointing towards a massive rally in the dollar, we just didn't get it. And to be honest, in all of the years, decades now that I've been trading, I've never seen such a flaccid reaction to such a strong jobs report. It used to be over the years that I've traded that when you get a strong jobs report, particularly a really strong one, with very low unemployment, that we would see a huge rally in the dollar. It happened time after time, month after month, year after year. It was kind of a foolproof trade, but we didn't see that on Friday for the jobs report, and that makes me a little bit concerned that the dollar might not hold its support and that the euro, the pound, the yen, and all the majors might rally against the dollar going forward. However, we're still short the euro as long as we technically hold beneath this channel line, and as long as we're not making higher highs above 1.1, looking for the euro to move down. However, this is really completely up in the air, and if the euro does move up, we're going to have to stop out or hedge our short positions and then wait to see what happens thereafter. The same thing actually goes for the pound, and in fact, unlike the euro, the pound actually gained strength on Friday following that non-farm payrolls report, but only up to the 1.2630 region, which is a pretty long-term resistance level. As you can see, if we look at the weekly chart on the pound, there's the 100-day moving average, and there's the 200 just above it. But this green line here is a long-term resistance level. Just above there, we've got the 61.8% Fibonacci level. And if you look at the stochastic, we've got an overbought weekly stochastic. I'm just going to change the stochastic settings to the 1473 stochastic to give us a smooth picture on the stochastic. And you can see that even though we overbought on the weekly stochastic, we haven't reached the previous high that occurred over here. And even though we've got a rising price, we've got a lower high on the stochastic. So we've got potential stochastic divergence coming in with an overbought situation, and we've got the price moving right up into this resistance level at around about 1.2640, and potentially we could get up to 1.2760 or so, where the 100-day moving average is. Interestingly, on the pound, if you look at the 200-day moving average, that's this purple line here, since 2020, the weekly 200-period moving average is just moving sideways. So in all that time, in fact going all the way back to 2018, there's been very little movement on the pound, and we pretty much ranged, and we've reached the kind of middle of the range right now. I think with the economic activity in the UK, I think with the pressure on them not being able to increase interest rates as readily as they can in the US, and various other pressures going on in the European zone right now, I think we've got every chance of the pound falling back down a little bit lower, perhaps down to 1.18. If you remember, in September last year, the pound actually collapsed all the way down towards parity with the dollar, and everyone was calling for parity with the dollar. And that's the lowest that the pound had ever been against the dollar. So we've got an overall downward trend on the pound versus the US dollar since Brexit, various other economic factors going on in the UK. I suspect that we may see further weakness in the pound, and now would be a good place for this to turn around. I'm not going to zoom into the Canadian dollar charts, but we've got four of them along the bottom here: the Euro CAD, the Pound CAD, the CAD Swiss franc, and the US dollar CAD. And look at how the Canadian dollar strengthened against all of these pairs. What we didn't see on the dollar charts against the major currencies, in other words, a dollar rally with the NFP, we saw on the Canadian dollar charts, with the Canadian dollar rallying against the euro, the pound, the Swiss franc, and against the US dollar. Our positioning on all of these is that we're short across the board. We're short euro, US dollar, we're short pound, US dollar, euro CAD, pound CAD, we're long on CAD Swiss, and we're short on US dollar CAD. So that's our currency approach for now. How this is going to change in the coming weeks, I don't know. But I must say the fact that the dollar did not rally after that jobs report is pretty concerning for euro and pound and Australian dollar shorts. We'll have to keep a very close eye on it. And I think it's all up for grabs right now. On a slightly more comforting front, we've got the Japanese yen pairs, and we've been short dollar Japanese yen and euro Japanese yen, and those continue to look good. If you'd like to see the technical analyses on these, go and have a look at my 2 previous videos on currencies and stocks and gold, and you can find out what's going on there. But in brief, we reached this resistance level on the dollar yen against the 200-day moving average and this technical trend line, this resistance, head and shoulders, potential line, downward sloping head and shoulders line, whatever you want to call it. We formed a reversal candle that we were short right from the top. We formed a daily dark cloud cover candle, and for the last couple of days we've been moving down on the dollar yen. We've been short from there. We're looking for a break of this upward sloping trend line, and then we expect the dollar yen to move down into lower levels, back down to the high to mid 120s. So we've got to get through this trend line and the 20, 50 and 100-day moving averages, which are just below us. So expect a little bounce off here for now, maybe a little bit higher up into about 135, maybe 136, and then a continued move down for the dollar Japanese yen. And that actually would fall pretty much in line with our worst case scenario for the euro and the pound against the US dollar. At the same time, we're also short euro Japanese yen, and for similar reasons we've moved up into resistance. I'm going to have to put the weekly chart up on here for you to get a better view. And that's where we stand on the weekly chart. Very, very overbought, way out of its median range, which is in the sort of mid 120s to mid 130 range. Way down below us, we're at about 150 right now. Above us, we've got the 78.6% Fibonacci, which is kind of the last chance reversal area. We've moved up into this resistance zone, this green line here. We just pierced through it and then fell back down again. And we've also got these sort of tendrils of support going back into 2007. So this whole region here is a really good resistance zone. And again, the fundamentals in the Japanese economy, their negative interest rates and their need to increase it at some stage, or at least talk about increasing it, their increasing inflation, their balance of trade, all of that sort of thing, lead me to expect that we'll see some more strength in the Japanese yen in time to come. So look for a continued move down. We're short on this pair as well. We're short on the dollar yen and this one. Look for a continued move down, first of all into the support level at around about 140 to 141. And then with a bit of luck, we'll get back down into the mid 130s. With the recent strength we've seen in Australian dollar and Canadian dollar, you can see these are both rallied against the Japanese yen. Fortunately, we haven't been short on these 2 pairs, and for now we're going to stay out of those. But I think these 2, dollar yen, euro yen, are pretty good for short trades right now. Very quickly looking at the stock markets, again, please have a look at the previous video that I put up yesterday and a couple of the other thoughts, and also I've got some ideas on Twitter on these. We're just seeing strength in the stock markets. Having said that, we're short on Nvidia, we're short on Apple, and we're short on, we'll have to wait to see how those go. I really don't know. I don't think anyone actually knows what's going on in the stock markets, whether we're going to see a capitulation by the bears and the markets begin to rally, or whether the bears and the enormous short interest that's being built up in the markets will overcome this sort of exuberance and bullish exuberance. The idea that the Fed might flip its stance and change direction, the bond market seems to think so. Really, it's pretty much a coin toss right now, but we're betting on the short side very, very gingerly for now. We're not short on the indices, but I will look to short the S&P. This one's been the weaker between the 2, the NASDAQ and the S&P. We've got this brick wall barrier up above us. I think I put up quite a funny little tweet about that. You can have a look at that. The battle of the bands. We've got the wall against the don't worry, be happies just beneath us. That's these moving averages, Bob Marley moving averages, and the Pink Floyd brick wall. But we've got this funnel pattern developing, megaphone pattern. And these are really good, reliable reversal patterns. It's an expanding pattern, and we expect once we get to the top of this, having broken up perhaps above this recent high and some of these highs here, we'll reach the top of this megaphone pattern and then begin to move down back towards the bottom of this megaphone and these moving averages. So I'll be looking to short the S&P index into the top of this area here whenever we get there. It could be just a day or 2, or it could be a week before we get up here if we do, and I'll be looking to short that. Alternatively, we might not actually get above this red line, and we might end up breaking down through the bottom of this pattern and these moving averages before we get to the top. I don't know. In lieu of that, however, we are short Nvidia, Apple and Microsoft. I guess these will all fall pretty much in line with what happens on the stock indices. Apple, this is an interesting pattern. Just quickly while we're here, we've got a similar pattern. We've got an expanding megaphone pattern. If you imagine the line going up, I'm not going to draw it now, but if you imagine the line going up along here at the top and a similar line going down here along the bottom, you'll see a picture something like what the S&P looks like, we just had a look at. And we've got this big gap in the middle that occurred after earnings. So that gap needs to be filled at some stage. There are a couple of gaps above us, but I think if we can hold beneath this red line, that's the top of the megaphone pattern. I've actually drawn this out on Twitter, so you can go and have a look at my Twitter account. The links are in the description. You can have a look at this, but I think we need to head back down into here. I really don't know. And I'm just playing this as a probability trade. We've got fairly tight stop losses on this. If it doesn't work out, we'll lose a bit. If it does work out, we'll gain a lot more than we lose. Right, now let's have a look at some of the commodities. First of all, I think the three that I want to focus on here, and very briefly, because I'm going to do a separate video on natural gas tomorrow, but I'm going to look at quickly at gold. Gold has reached its all-time high and formed a triple top so far, actually. We were short gold from the top of this move, and we managed to get a good chunk of that move down, but we got very close to the 2000 level again. It's obviously a really big number. It's a big psychological number, and it's a beautiful number. We got down there, we took profits just ahead of that, and you can see we've bounced back up above there again. Once again, gold, I don't know. It's really, really tricky. If we don't manage to get back down through 2000, and we can actually draw sort of a trend line here on gold, and it sort of ends up at around about 2000. And as long as that trend line holds, which it looks like it might do, because we haven't even managed to break down through this 20-day moving average, gold will probably then move up through this high and begin to make dramatic new highs. However, if we do manage to break down through here and get down to some of these lower levels, I'll be looking to buy gold somewhere between 1,920 and 1,780. What I'm going to do is actually just draw a Fibonacci study on here from the bottom to the top, and I'm going to go roughly off these Fibonacci levels and also the support and resistance lines that I've got drawn in here. This purple line is the sort of channel top, so that'll provide the first part of resistance, and it's also where the 50-day moving average is, and that's at around 1,950. Below that, we've got the first Fibonacci, the 38.2% fib. That's at about 1,900 to 1,920. And then we've got various other levels down here, 1,850 all the way down to 1,780. So any of these levels beneath us on gold will be areas that we look to buy at, and we're going to have to be nimble on this. We're going to have to trade quickly. We're going to have to watch our positions. We might get stopped out of a few positions. We might have to take a few trades off at break even if the trades don't get going. We'll have to play this with a bit of agility, a bit of dodging and weaving, and a bit of flexibility. But overall, I'm going to be looking to buy gold into any of these levels. I think the best level overall is around about 1,900 to 1,920. I think if we do move down through this short little trend line here, we'll probably break down through this channel top so that we can clear out a few long positions and make space for some fresh ones. And I think around about this level here with 100-day moving averages between 1900 and 1920 be a great place to buy gold. We have to allow, however, for a dip further down towards the 1800 to 1820 level. I'm not too sure we'll get there, but that is the strongest place for gold to find a base, being the center of this overall long-term area of consolidation, supply and demand, ranging back and forth. That area right in the middle of all of this congestion is probably the strongest region to buy gold. However, this is a bullish market, given the uncertainty in the markets and with banks and stock markets and interest rates maybe coming down, people expecting that bonds might be coming down. With all of this confusion, there's one certainty, and that's that people will turn to gold. And I think we're going to see more strength than weakness in gold in the short to medium term. So look for support around about 1900 to 1920. Top of this channel and into this first Fibonacci level, the 38.2% Fibonacci, at around 1900 to 1920, allowing for dips further down if we need to get down there to pick up further liquidity for long positions. Let's go straight across to natural gas. And like I said, I'm going to do a new video on this on Monday. That's tomorrow. But just to update you on my positions, and I'm going to switch across to the futures contract I'm trading myself. I took a long position at 2.11, $2.11 on natural gas. There's an explanation for it on Twitter as well. There's a reason I took that trade, and I put the explanation up on Twitter. It's a quarter-sized position. It's not a full-size position. It's a quarter of what I would like to have on this trade, allowing for another dip back down to $2 and perhaps even further down to $1.80 and $1.50, which are my two support levels beneath us that I consider to be worthwhile looking at. So far, I've got a quarter-size position on at $2.11, and I'm going to show you why quickly on the hourly chart, why I took that trade. If you remember, I said I might consider looking to buy natural gas again if we got got close to $2. We did in fact get close to $2. We got down to $2.03. And that's when I started getting interested in long positions again. You can see when we got down to 2.03, we formed this piercing pattern, bullish engulfing reversal candle, waited for us to break above this 20-period moving average. This is the hourly chart. And then I waited for us to break above this red resistance level over here, which we did with one big bullish hourly candle. And the moment we broke through there, I took the trade at $2.11. Since then, we've moved up a bit, we've come down a bit, and we're still hovering at around about that price. Whether we'll hold that or not, I don't know. It looks like a good breakout to me. We did come back to retest it, so that's always a good sign. And if that retest holds at 211 and we begin to move higher, then that will have proved itself to be a reasonable support in at least the short term. Remember, this is a quarter size position. I'm willing to add further to $2, $1.80, and $1.50, by which time I'll have my full position on natural gas. So right now, I'm just sort of wetting the beak, putting my toe in the water. It's a quarter size position. I'm not committing a full size position to this at this stage. But so far, so good. If we switch back to the daily chart, we've actually formed a pretty classic piercing pattern. We opened lower than the previous day's high. We made a little wick bottom. We spiked up. We moved up above halfway of that previous bearish day's candle, and we closed more than halfway up through that candle. That's a beautiful piercing candle pattern, and you can see it's all taken place around this support level here, this red line that I've drawn across at $2.11. Could call it $2.12, thereabouts. And as long as we can break up through here, hold above here, and we might even gap up over the weekend. We've seen some news on Natural Gas World about Equinor's Hammerfest LNG plant offline after outage. Don't know if that's going to affect prices. Maybe that will contribute towards a gap up as the week opens. This plant's going to remain offline until repairs are being carried out. This one supplies about 6.5 billion cubic meters BCM of gas per year, enough to cover the energy demand of about 6.5 million European homes, or 5% of all Norwegian gas exports. So that might have an influence. I'm not too sure. It doesn't seem like enormous news, but possibly. So that's where we are on natural gas. And like I said, I'm going to do a video on Monday, that's tomorrow, specifically on natural gas to update my position on that. The only other things are sugar. I'm going to look to short sugar again. I'm not going to cover that in detail in this video, but sugar's moving up into a level just below this recent high where a short trade looks interesting at this resistance level here. Long on URA, this is that uranium CFD, long on that, and that's moved up quite beautifully since we took our position. And then the other one is WTI. This is oil, and we took a long position on this spike down in the middle of the night, my time, 4 a.m. Again, there are some details up on my previous video on WTI, and I've also tweeted on this on a number of occasions, but we're long on this one. We're holding that position, looking for a move up to about $74. And perhaps with a bit of luck, we'll get a break above this channel bottom, a move back into the inside of the channel, and then a move back up to the channel top again at around about $84. We've seen quite a lot of volatility. That gap there was caused by the OPEC cut, but that rally and that gap up didn't hold. We failed, we broke down, filled the gap down below the channel line, but then a big massive spike wick bottom against $64 on Thursday. And with a bit of luck, this will continue upwards towards this red downward trend line and the channel top. So far so good for our position on WTI oil. And I think that's all for now. I'm not going to say anything about Bitcoin because, quite frankly, it's been rather boring for the last number of days. In fact, going all the way back into the middle of March, we've just moved sideways. But I think actually Bitcoin's looking rather supported. And I think anyone who's bearish in Bitcoin, and there's a fair number of them, I think they might find themselves on the wrong side of that trade. Well, take care. Have a great trading week ahead of you. We've got all sorts of things to deal with. We've got all these commodities. We've got stocks being silly and crazy. We've got the yen pairs. Who knows what's going to happen with those? I think those are going to be good, though. And then we've got the majors against the US dollar. Goodness knows what the US dollar is going to get up to in this coming week. But so far, we're short all the majors against the US dollar and against the Canadian dollar. If you've enjoyed the content of this video, please give it a thumbs up. And also, if you're new here, consider subscribing to the channel for further updates. Take care.